Welcome to Stock Market Palantir. In this video, we'll be breaking down another stock analysis. Be sure to subscribe and drop your opinion in the comments. Okay, let's hear from our analysts.
All right, so today we're diving deep into a stock that sits right at this explosive intersection of bleeding-edge space technology and, well, pretty ruinous corporate finance. Ascent Solar Technologies, Inc., ASTI. This is a story you just can't understand by looking at the balance sheet or the product sheet alone. You really have to look at the market plumbing. The volatility we saw in December 2025 was exceptional. We need to analyze the immediate catalyst, the price action on Friday, December 19th. The stock surged a massive 37.79%, moving from $3.07 to close at $4.23. And it even touched an intraday high of $4.90. This all happened on volume that just exploded, trading 4 million more shares than the day before. The central conflict we're addressing today is, it's simple, but it's profound. Is this volatility and the corresponding valuation truly being driven by the underlying necessity of ASTI's solar technology for the space economy? Or is the price movement ultimately just contained and defined by its crippling, hyper-dilutive capital structure? I'm going to argue that the technology and the market microstructure, specifically a short squeeze setup, are the primary drivers of what we're seeing right now.
Okay, and I see why you'd think that, especially when the price action is so dramatic. However, I come at it from a fundamentally different place. While the product is compelling, I maintain that the company's structural history of dilution, which has just functioned as this constant drain on shareholder value, combined with the severe overhang of current warrants, well, they're simply insurmountable headwinds. They establish a very hard ceiling on what this stock can achieve long-term. In my view, the technology moat, however strong it is rendered effectively irrelevant to anyone holding this stock beyond, a very short-term trade. This spike is, historically speaking, just another opportunity for financial engineering to take priority.
Let's start then with the technological edge, because without a valuable product, all the financial drama is just noise. ASTI isn't making standard rooftop solar panels. They're copper indium gallium diselenide, or CIGS technology. It's printed on a flexible polyamide substrate. Now, why is this so critical? Because it addresses the single most brutal constraint in the new space race: mass. Every kilogram launched into low Earth orbit costs a fortune, yet you have hyperscalers, potential defense contractors, all trying to deploy dense AI compute in space. They need massive power, but they just cannot afford the mass penalty of traditional silicon. AST's specific power ratio, up to 1900 watts per kilogram at the module level, that is why they are suddenly so indispensable. That is the key metric. That number essentially makes them the pick and shovel provider for the space AI gold rush. They provide the lightweight, efficient energy that lets everyone else deploy their heavy compute infrastructure. The market narrative connecting AST to things like Google's Project Suncatcher, well, it's based on real structural demand for this exact type of film.
I won't dispute the efficacy of the CIGS film as a physical product, but the historical behavior of the company's equity structure is the true measure of management's intent, and it is overwhelmingly negative for shareholders. The experience of holding this stock has historically been defined by the death spiral financing structure. This is a painful mechanism that allows companies to survive by just perpetually issuing cheap shares, often convertible notes or warrants, to maintain their NASDAQ listing, but it functionally destroys equity value. And to illustrate the severity, we need to talk about the cumulative effect of the reverse stock splits since 2014. If you take all of those splits together, the cumulative ratio amounts to a factor of 20 trillion. 20 trillion to 1. That is not just poor performance. That is a statistical declaration that any long-term shareholder has been, for all intents and purposes, wiped out of existence. It proves historically that this company uses any rally like the one we just saw as an engineered selling opportunity. So the current shareholder base isn't long-term investors. They're speculators trading on technicals, totally disconnected from the company's health.
That historical damage is a scar, undeniably, but it's history. It doesn't explain the immediate, violent, short-term repricing we witnessed in December. That 37.79% surge. That's a function of pure market mechanics colliding with a critically thin public float. The catalyst is technical and it's mandatory. ASTI's presence on the regulation SHO threshold security list, which was confirmed on December 19th, the day of the spike. For anyone in the audience who might not trade microcaps daily, this list is significant. When a stock is placed on Reg SHO, it means there has been a persistent failure to deliver shares, FTDs, which means short sellers sold shares they couldn't actually locate. We saw big FTD spikes over 100,000 shares on November 7th, for instance. Once a security is on that list for 13 consecutive settlement days, SEC Rule 204 is triggered. That rule mandates a forced buy-in. This isn't optional, it's a physical requirement for the broker-dealer to buy the shares back at whatever price is necessary. That forced, price-agnostic demand is precisely the mechanism that created that massive repricing. The short squeeze is what's dictating the value right now.
That is a compelling explanation for the immediate volatility, and I appreciate the clarity on Redshow. However, that technical structure, which relies on these squeeze mechanics, it is fundamentally capped and contained by the company's own recent financial actions. We have to look at the dilution that happened earlier in December. The $2 million private placement on December 8th was not just a cash infusion, it was loaded with highly dilutive warrants. Specifically, the Series A and B warrants are exercisable for over 2 million shares at an extremely low strike price of $1.70. This effectively establishes a new soft ceiling for the stock. If the price goes substantially above $1.70, the warrant holders are sitting on an instant, risk-free profit incentive. They will sell aggressively into that strength, lock in their returns, and flood the market with new supply. It's guaranteed selling pressure. And on top of that, let's not forget the S3 shelf registration filed in October for a massive $100 million. That signals management's clear intent. They plan to sell a lot more stock if they can. Their focus is funding operations through the share price, not through real revenue.
I acknowledge the immense bearish pressure that warrant overhang creates. But let's look at the signals the market is responding to, which are giving cover for that squeeze narrative. The technology's feasibility isn't just a white paper concept. It's backed by verified flight heritage. AST modules flew on the MISA-X experiment on the SpaceX CRS-30 mission back in March of 2024. In the aerospace sector, verified flight heritage is the single most powerful trust signal you can send. It dramatically reduces the risk profile for potential large customers. And speaking of trust, look at the board. Forrest Reynolds, a former founding member of SpaceX who oversaw critical R&D, is on that board. That is a strategic bridge to future contracts. Starlink V2 Mini, other constellation bids, that matters more than current revenue for a high-potential stock like this. You can't just dismiss the structural demand or the caliber of the industry endorsements.
That's an interesting point about the trust signal from Forrest Reynolds. But let me give you a different perspective on what those relationships mean right now. These are teaming agreements and tests, proof of concept, yes, but they are not sustained revenue-generating contracts. So I'll counter your strategic vision with the immediate cash reality. That $2 million raise you mentioned was explicitly for working capital, yet their Q3 2025 net loss was $2.02 million. Their runway is not just short, it is virtually non-existent. The technological feasibility is irrelevant if the company can't survive long enough to monetize it. Their desperate, continuous capital needs, proven by this recent dilutive offering, that's what dictates their immediate actions, not the promise of some future Starlink contract.
But that still doesn't address the raw physical market pressure that drove that 37% move. You can't just dismiss the power of the short interest combined with the Reg SHO status. If we accept the short interest is high and the float is thin, this setup implies aggressive speculative selling that has become physically trapped. The forced buy-ins under Rule 204 are non-negotiable. The stock is being forcibly elevated by the very people who bet against it.
I'm sorry, but I just don't buy that the high short volume is purely reflective of speculative bearishness. We have to look at the nuance of when that volume occurred. And let me tell you why the timing is so critical. The spike in the off-exchange short volume ratio hit a staggering 82.12%, specifically on December 8th, the exact day the private placement was announced.
Wait, hold on. Are you suggesting that an 82% short ratio isn't even truly a bearish sentiment? That's phenomenal if it's true.
Exactly. That ratio is so high, it's far better interpreted as market makers aggressively shorting the stock, not as a speculative bet, but to facilitate order flow and to hedge against the newly incoming massive share supply priced at 195. This is the operational plumbing of the market managing dilution. If they know the company is about to flood the market with cheap shares, they short immediately to hedge their position. It's operational risk management, not a purely speculative bet against the company's future. It just proves the enormous new supply is the dominant mechanical factor here.
That is a fascinating, sophisticated interpretation of that data, suggesting the shorting is reflexive to the offering rather than predatory. But even if we accept that, doesn't that logic just reinforce the volatility? If market makers are using the float as their inventory tool, the thin float becomes even more susceptible to violent moves when real demand appears because their capacity to manage that inventory is so reduced.
Perhaps, but it brings us back to the most formidable continuous structural headwind, that 1.70 warrant strike price. This low strike price acts as a continuous supply cap on any rally. The investors who got shares at 195 and have the right to buy more at 170 are incentivized to exercise those warrants and sell those shares into any strength to lock in instant profit. Every single rally is destined to be capped by this structural supply, making sustained appreciation extremely difficult, regardless of the tech story.
That structural selling pressure is undeniable. But conversely, the possibility of the $3.5 million in funding that would arrive if those warrants are exercised creates a powerful aligned incentive for the company and certain financial players. They desperately need the stock price to stay above that $1.70 strike price. If the stock drops significantly below that level, say it's trading consistently in the low dollar range, that vital cash source, $3.5 million that could cover almost 2 more quarters of losses, it just dries up. The warrants become worthless. This failure would lead inevitably to another, even more dilutive offering. So the market has this perverse structural incentive to defend that $1.70 level to keep the company solvent. It effectively acts as a technical floor, not just a ceiling.
I agree it creates a floor, but the problem is that the defense of that floor comes at the direct expense of any equity expansion. You're trading near-term liquidity for long-term shareholder value via persistent, massive dilution. It only confirms that the underlying technology is not yet generating enough sustained commercial interest, multi-year revenue-generating contracts, to dictate its own valuation. Until AST secures that kind of cash flow, the financial structure defined by capital desperation will always be the dominant force.
And I still maintain that while the financial constraints are immense, the dominant factor for the current explosive volatility is market microstructure. The technology story, the connection to flight heritage and space AI is providing the necessary narrative fuel. But the short squeeze mechanics, the Reg SHO status, and forced buy-ins are providing the physical mandatory thrust that pushes the price past key thresholds, overriding the financial logic in the immediate term.
And I'll reiterate that while the core technology is physically sound, the structural headwind created by the cumulative 20 trillion to 1 dilution history and the current warrant overhang is it's too formidable. It renders the long-term viability and any sustained appreciation inherently uncertain. The company's desperate short-term capital needs define its daily existence, not its promising product roadmap.
So we've really explored the intense battle raging within ASTI, the inflationary pressure of a short squeeze, driven by technical factors like the Reg SHO list, fighting directly against the deflationary pressure of massive dilution from the recent warrants and the threat of that $100 million shelf registration.
Indeed. ASTI represents a classic, perhaps an extreme, binary investment proposition, where the fundamental truth that the technology is validated and necessary battles the harsh, inescapable reality of its market structure and its troubled financial history.
The outcome of this immediate conflict is currently being determined by key technical support levels. Specifically, whether the stock can hold the critical $3.57 level established during that violent December rally. If it holds, the squeeze narrative gains the credibility it needs to sustain momentum.
And if that level fails, the gravitational pull of that structural 170 warrant strike price and the continuous supply it represents will likely reassert itself and force the price back down. This situation is a powerful reminder that every participant, whether a speculator or an analyst, has to weigh both the market microstructure data and the painful financial history when evaluating these highly volatile assets.
If you enjoyed this video and want to watch more analysis like this, don't forget to subscribe to the Stock Market Palantir channel. Thanks for watching, and see you in the next video.